JVC could see 10 to 15% price corrections in 2026 due to new supply. But for cash flow investors, this might be the best entry point in years. Here's your complete mid-market analysis. Welcome to Dubai Daily, your essential morning briefing on Dubai's real estate market, brought to you by Parag Kundalwal, founder and CEO of Consultaa, a Dubai-based real estate consulting and global capital advisory firm. Today is Thursday, January 8th, 2026.
And on today's episode, Mid-Market Correction Watch. We're analysing the risk and, more importantly, the opportunity in Dubai's potentially oversupplied segments like JVC, Business Bay, and Arjan.
That's right, Lily. The big number everyone is talking about is 64,000. That's the estimated number of units delivering in 2026, a significant jump from the 37,000 to 42,000 we saw in 2025. And the mid-market segments are facing the highest concentration of this new supply.
Let's break that down by community, starting with the one everyone asks about, Jumeirah Village Circle, or JVC. We're seeing studios delivering now around the 687,000 dirham mark, offering excellent average yields of 7.82% and even pushing past 9% for some studio units.
But that new supply poses a real risk. We're forecasting a potential 10 to 15% price correction there in 2026. The saving grace for JVC, however, could be the future Green Line metro extension. That infrastructure catalyst provides some long-term protection.
Now let's contrast that with Business Bay. Here, studios are closer to 750,000 and two beds are around 1.8 million. Yields are a bit tighter, between 6 to 8%. The supply pressure is moderate to high, but it has some powerful defensive characteristics.
Exactly. Its proximity to the Metro Red Line and DIFC is a huge anchor. Plus, you have significant institutional buyers in Business Bay. That liquidity and professional ownership provides a price floor you don't see in purely retail-driven communities. So, the correction risk there is lower, somewhere in the 5 to 10% range.
Then you have areas with much higher exposure. Arjan, for example. Yields are around 6 to 7%, but the supply pressure is very high. It's a developer-heavy area, and we could see a correction of 15% or even more. It has limited infrastructure to cushion that blow compared to a JVC or Business Bay.
Sports City is in a similar boat, with 6 to 7% yields and high supply pressure leading to a 10 to 15% correction risk. It has established amenities, which helps, but fewer alternatives for families looking to move. And finally, International City. It's an interesting one. Yields are fantastic at 8 to 9%, but it's a mature market with only moderate new supply. Correction risk here is more in line with Business Bay, around 5 to 10%.
And the big catalyst for International City is the Metro Blue Line opening in 2029. That infrastructure story is a powerful long-term hold narrative. So for investors watching this unfold, what are the canaries in the coal mine? What are the key correction indicators to monitor?
The first and most immediate is days on market. In a normal, healthy market, a property is listed for about 15 to 25 days. When you see that number creep up to over 30 days, that's a warning sign of buyer caution. If it hits 45 days or more, you're seeing serious pressure.
And investors can track this themselves on portals like Property Finder and Beirut, looking at specific community data. The second indicator is transaction volumes. The Dubai Land Apartments monthly reports are your best friend here. Declining volumes, especially when compared year over year, clearly indicate softening demand.
A third and very telling indicator is the return of aggressive developer incentives. We saw these pre-2020, things like 1 to 3 years of free service charges or payment plans shifting from a standard 60-40 to an 80-20, or even more creative structures like 10-70-20.
Furniture packages, below market pricing. When you see these, it signals developers are facing absorption challenges and are getting urgent. Finally, watch the rental market. Are vacancy rates ticking up? Are landlords offering 1 or 2 months free? That tells you the new supply is starting to bite.
Okay, so let's game this out. What do these corrections actually look like in terms of price? Let's run through a few scenarios. First, the best case, a 5% stabilization.
This would mean the economy is strong enough to absorb the new supply quickly. That 687,000 dirham studio in JVC would adjust to around 652,000. A 1.5 million dirham apartment in Business Bay would dip to 1.42 million. A very minor impact, really.
Then we have our base case, a 10% moderate correction. This assumes supply absorption takes a bit longer, say 6 to 9 months. That JVC studio now drops to about 618,000 dirhams. The Business Bay apartment goes to 1.35 million. For new entrants, this is where it gets interesting, as yields start to improve.
And finally, the bear case, a 15% significant adjustment. This would likely be triggered by the oversupply combined with some unforeseen economic headwinds. The JVC studio could fall to 584,000. Arjan would be hit the hardest. But for a patient, contrarian investor, this is the best opportunity.
It absolutely is. So, how can investors find properties with more downside protection even within these communities?
Number 1 is what you mentioned earlier, metro-linked properties. The Red Line in Business Bay, the future Blue Line corridor near International City, infrastructure creates resilience. Number 2 is focusing on established buildings, say those built between 2015 and 2018. They have a proven track record of quality and management and often have high occupancy rates above 90%.
And that ties into the third point, well-managed communities. Buildings with professional management and active owner associations tend to maintain tenant satisfaction and occupancy, even when new, shiny towers are opening up next door. They have pricing power.
So given all this, Daniel, what's the timing? When is the strategic entry point for a new investor looking to capitalize?
We see Q2 and Q3 of 2026 as the sweet spot. Q1 is the pre-supply window. Prices are still at current levels, but you're buying right before the major deliveries hit. Q2, from April to June, is when that first wave of 64,000 units hits the market. You'll see days on market increase and developers start offering those incentives.
And that sets up Q3, July to September, as the optimal entry point. By then, the market has had 3 to 6 months to absorb the new stock. Pricing becomes clearer based on actual supply and demand. You'll find motivated sellers in the secondary market and maximum flexibility from developers. That's the best risk-reward timing.
By Q4, we expect to see recovery signals as the supply gets absorbed. So let's talk strategy. How can investors play this? For existing investors who bought between 2020 and 2023, they're likely sitting on significant appreciation. A 10-15% correction erases some paper gains, but they still have positive equity. With strong rental yields, the simple answer is to hold.
Or they could employ a rotate strategy. Sell a property in a high-risk segment like Arjan and redeploy that capital into an infrastructure-linked location with a better long-term story, like Dubai South or Creek Harbour. You maintain portfolio value while improving its quality.
And for new investors, this is where the aggressive entry strategy comes in. Target those 15% correction scenarios in JVC or Arjan. A cash buyer with a 2 to 3 year horizon can pick up assets where the rental yield, based on the new lower price, could push 9 or 10%.
For those who want to reduce timing risk, a gradual accumulation strategy works well. It's like dollar-cost averaging for property. You buy in tranches throughout Q2 and Q3 as prices adjust, building a multi-unit portfolio at a blended, optimal price.
Excellent points, Lily. So, let's wrap up with the key takeaways for our listeners.
First, 64,000 units in 2026 create a 10 to 15% correction risk in mid-market segments, especially JVC and Arjan.
Business Bay shows lower risk, around 5 to 10%, thanks to metro access and institutional buyers.
Key indicators to watch are days on market rising above 30 days, declining transaction volumes, and aggressive developer incentives.
Look for downside protection in metro-linked buildings, established communities with high occupancy, and professional management.
The strategic timing for optimal entry appears to be Q3 2026, after the initial supply shock has been priced in.
And most importantly, this is a contrarian opportunity. Cash flow investors can benefit from improved yields at lower entry points, provided they have a 2 to 3 year time horizon. And that's today's Dubai Daily. Mid-market corrections create fantastic opportunities for disciplined investors who are focused on cash flow and long-term value, rather than chasing short-term appreciation. For personalized mid-market positioning and a contrarian investment strategy, reach out to me, Parag Kundalwal, at Consultaa. You can contact me via phone and WhatsApp at +971 58 596 4631. Email me at parag@consulta-dxb.com. Visit our website at consulta-dxb.com and connect with me on LinkedIn under Parag Kundalwal.
Follow us on Instagram at Consulta-now. Dubai Daily airs Monday to Friday at 7 a.m. Dubai time. Subscribe for your daily dose of Dubai real estate intelligence.